When we're talking about in the investment chapter, I'm okay with you doing most of the investment by yourself. You really can. Tax planning, you need help. This is where a certified financial planner can help you through. Some CPAs will help you through actually creating a plan for this. Because what happens is people will see cool ideas. So let's say a backdoor Roth. Backdoor Roth is what you do when you make too much money to contribute to a Roth IRA. But you need to do it very, very specific set of steps. You need to have no money whatsoever in your traditional IRA, and then you can make a non-deductible contribution. Then you can roll it to your Roth IRA. Now, here's the thing. I find people mess this up all the time because you also have to file a form called an 8606. You have to keep track of it. Like, there's a whole bunch of paperwork. And once you've done it wrong, we need to undo it or else you start paying penalties. And it's a mess. It's a cool tax trick. Allows you to put money into your Roth if you make too much money, but it's a lot of work, and you got to do it right.
Welcome to the Childfree Wealth Podcast, hosted by Bri and Dr. J, certified financial planner. Here we discuss life and finances as it relates to being child-free. This podcast is for educational and entertainment purposes only. Please consult your advisor before implementing any ideas heard on this podcast.
Hey, Childfree Wealth listeners. We are in the book club talking about the third part of my new book, The Child-Free Guide to Life and Money. So we're getting in that last third of the book about taxes and other considerations. At one point I had named this section potpourri, just everything left over. And what it was the things that didn't fit in our life or financial planning, but do impact people. If you haven't picked up the book, go to your local bookstore, pick it up. Got to order on Amazon, Barnes & Noble, whatever. Go to the local library, get it, because it's going to dive into some things. And I'm not going to cover everything that's in this section, but I'm going to take the ones that are high points and work that through. So the first part of this is chapter 17 on tax planning. I'm going to spend a bit of time on this one because investing can be very simple. Tax planning can be a challenge. And just some kind of terminology so we get it. Tax planning is figuring out what you're going to pay for taxes and how and when over the rest of your life. Tax filing is like when you put in your 1040 once a year before April 15th. What often happens is your CPA or EA, which is an enrolled agent, tax preparer, files your taxes. I don't do that. I file my own taxes. I've done that a couple of years. Now I pay a CPA because it's just, I don't want to be doing that. But what we do as certified financial planners and Childfree Wealth specialists is tax planning. We're looking at it over the long term. I'll be frank, we sometimes argue with CPAs. They're 100% right on the way it's invested, the way it's reported, the way you fill out the form. I agree. CPAs, interestingly enough, can read the guidelines and make some decisions in the gray that I can't. But they tend to look at 1 year. I'm saying, okay, maybe we pay a little more taxes this year, but it saves you more in the future. I'm looking at it over a long term, and that's a different way of thinking. When you get in tax planning, what you're going to find is we talk about income tax, capital gains tax. Income tax, people usually think about like, I got paid on a W-2. That's my paycheck. I get income tax. Yes, it is also interest. So what happens is if you are in one of the high tax brackets, go into the chapters, a whole bunch on this. I'm not going to touch all taxes. It'd be like 6-hour discussion. But when you're in one of the higher tax brackets, let's say you're in the 30-something tax bracket, every dollar you earn in interest gets taxed at that 30-something%. And then it gets taxed at the state level. Now, I'm in Tennessee right now. We're in a state with no income tax. That's cool. I don't have a state income tax, but most states do. If you're in a high tax state, something like California, where it's getting close to 10%, between your income tax and California tax, if you're in the higher tax brackets, you're paying 50% of your money in income tax. We want to look at your investments and say, okay, I don't want income coming off it. I want capital gains. Capital gains tax, the top rate is 20%, but most people are living in the 15% range. The states usually count that as the same as income, so you got to pay it there. But big difference in the federal, like cuts it in half. And you only pay capital gains tax when you sell the stock or sell the asset. And if you've held the stock for a certain period of time, even the dividends are considered capital gains. It's called a qualified dividend. So that's important. And what ends up happening is which accounts you have and how you invest it make a difference. So like this is when you're doing the debate of like, well, should I use a Roth account or traditional? Is it a 401k, an IRA, a taxable account, my savings account? All of that matters. When we talk about investing, what we want is your income producing stuff. That'd be like your bonds, money market, those go in your 401ks or IRAs, and your stock goes in your taxable. And like if you have international stock, you want to hold that in your taxable account because there's a tax break for what's tax paid internationally. It becomes a big issue. And then we get into like Roth conversions and giving and how does that impact it? Are we doing like a donor advised fund, a DAF to give to a nonprofit? How does that get written off our taxes? Are we giving away appreciated stock? Like there's a whole lot here. Now, when we're talking about in the investment chapter, I'm okay with you doing most of the investment by yourself. You really can. Tax planning, you need help. This is where a certified financial planner can help you through. Some CPAs will help you through actually creating a plan for this. Because what happens is people will see cool ideas. So let's say a backdoor Roth. Backdoor Roth is what you do when you make too much money to contribute to a Roth IRA. But you need to do it very, very specific set of steps. You need to have no money whatsoever in your traditional IRA. And then you can make a non-deductible contribution. Then you can roll it to your Roth IRA. Now, here's the thing. I find people mess this up all the time because you also have to file a form called an 8606. You have to keep track of it. Like there's a whole bunch of paperwork. And once you've done it wrong, we need to undo it or else you start paying penalties. And it's a mess. It's a cool tax trick. Allows you to put money into your Roth if you make too much money. But it's a lot of work. And you got to do it right. You can't mess around your taxes. Now, I'm going to be completely transparent with you. I am not going to be talking about, well, you can offshore your money and do a double backflip to save tax. No. We're not trying to like scam the IRS. We pay the IRS exactly what is owed, but we don't leave them a tip. Like we don't give them extra money just to give them extra money. And, people often with child-free folks will talk about tax like, well, I don't get a child tax credit. You're right. You don't get the $3,000, $3,600 or whatever, but you also don't have $18,000 a year in expenses for kids. Like you need to have a plan for your taxes. And this gets more and more important when you start looking at withdrawing money from your accounts. This is where we start talking about how do I get money to access to my 401k? So normally it's $59.5. You can actually get access earlier as long as you do some good tax planning. There's ways to do it. But you need to work with a professional. I'll tell you, I do a lot of continuing education, a lot of work, and I'm probably spending 1 or 2 hours every single month on the tax planning stuff. This month, I think I'm at 3 or 4 just to keep up to date on it. IRS just put out a chart on RMDs, required minimum distributions from inherited IRAs. I went to a whole session, it's almost 2 hours on that, did some research on it. I'll freely admit some of it I don't really even 100% get, but I have the charts. I know where to go. I know who to talk to. It's a lot of work to do tax planning and to do it right. Don't do this one alone.
If you enjoyed the show, please consider leaving a rating or review. We'd love to keep the conversation going. Please let us know your thoughts wherever comments are available or email us at media@childfreewealth.com. To stay up to date, find and follow Childfree Wealth on social media. If you're interested in working with us, learn more by visiting our website, childfreewealth.com. We'll see you next time.